the weekend, President Trump followed through with his tariff threat on key trading partners. And we think that effective, possibly tomorrow, Canada will see a 20% tariff on goods exported to the United States and a 10% tariff on energy resources. Stay tuned. In response, the Canadian government is imposing 25% tariffs on $30 billion worth of goods imported from the US. So as Canadians and investors alike digest all of this news, we want to share with you a short message from Fidelity Senior Vice President of Advisor National Sales, Dave Bushnell. Take a listen here.
Hi everyone, I'm Dave Bushnell, SVP Advisor Distribution at Fidelity. Over the weekend, Canada and the US began a trade war, with the US imposing a 25% tariff on most of our goods and 10% on our energy effective tomorrow. These are truly unprecedented times. And as a country and a community, Canadians and your clients will look to you and look to us for support and leadership to guide them through the uncertain times ahead and to help them meet their financial goals over the long term. Over the past 8 decades globally and 4 decades in Canada, Fidelity has been through major economic, political, and market events. And each time, no matter the type of shock, Fidelity has been there for our clients and for all of you. And as a source of information and insights, as a place of stability and service, and as your investment partner, dedicated and committed to your success. This time will be no different. Over the coming hours, weeks, and however long these rougher waters may be with us, we will be providing you timely and regular access to our investment experts, providing you our thoughts and analysis of what's happening and updates around how Fidelity's portfolio managers are actively positioning their portfolios to protect and grow your assets. As we share this content through Fidelity Connects, Fidelity Now, our sales representatives, and our website, I hope you get a sense that in this pivotal moment, and always, Fidelity has your back. In closing, I want to thank you for your trust in our team and in Fidelity, and for the tremendous value and advice you are providing each and every day, and for the support you will be providing to your clients. If you have any suggestions and ideas around how we could better support you as we face the next phases of the trade war together, please reach out to your Fidelity representative. And as always, thank you all for your partnership.
Wonderful message there from Dave Bushnell as we all pull together in this moment across Canada. Now, joining us here to unpack some of the latest developments, also the global market story, the macro picture for all of our integrated economies around the globe, is Fidelity Director of Global Macro, Jurrien Timmer. Hi, Jurrien. Great to see you. Thank you for joining us.
Good morning. I wish it was under more pleasant circumstances, but here we are.
Here we are, and we're delighted to have you take us through some of the bits that we do know, and then kind of the contingency stories for how things are looking. I might just ask you to peel through, we'll invite people to send their questions in here, to peel through the market reaction thus far, because it was interesting this morning, really kind of waiting on things. We saw, kind of a 2% drop off on the US side of things, which wasn't crazy, actually, considering there's can be a feeling of, real dire straits.
Yeah, so it's interesting. So obviously the announcement came on Friday. Over the weekend, the only market that was open, of course, was Bitcoin, and Bitcoin is the ground zero asset. And people are like, "Why is Bitcoin down?" It's like, well, because it's the only thing that's trading, and it's like a 3x Nasdaq, instrument. At least it has that kind of split personality. That part of its feature is that it's like the QQQ on steroids, and so that was an early indicator that the risk markets would open, down sharply. And of course, on Sunday night at 6 p.m., the futures markets open. And what we saw was, fairly predictable. So, S&P futures down 2%, as you mentioned. Dollar, of course, up strongly. The Canadian, the Mexican peso, the euro, the South African rand, the Indian rupee, all of those currencies way down. Um, Bonds were relatively unchanged, 4.5%. The Fed's not really going to need to be involved with this. So a very muted reaction from the fixed income side. But, equities down, dollar up, and that's kind of what you would expect. And you're right, it was maybe not as dramatic as it could have been. And of course, we've already walked back some of these moves after the announcement that Trump met with the Mexican president, and and it's just a lesson. And I think the market knows this, that even though there is a real systemic risk here, that if you do get an escalating trade war where things don't get walked back, obviously there are going to be economic consequences, especially for the countries on the receiving end of these tariffs, right? Because like in Canada and Mexico, these exports are your exports to the US are a far bigger piece of the GDP than the US exports to Mexico and Canada, right? But there are obviously consequences, but the markets know well that with this president, anything can happen at any time. And literally these things could be gone 5 minutes from now. And so the markets don't really know how to deal with that, right? Like you don't want to price in something that has lasting negative implications when you don't know whether this actually will be the case. So I think that creates maybe a measure of volatility for the markets, and that can be an opportunity. But it's very hard with this president and this administration to really know how much of this is fully intended as a lasting, change, and how much of this is just a negotiating tactic. And it's probably a combination of the both.
An aspect of I was hearing this term earlier, this sort of capital repatriation, just in light of uncertainty. Is there an element of people sort of retracting? I mean, that is part of sort of the tariff, a trade war, it can be called, the tariff story, is that people just sort of stay put a little bit, or even sort of retreat to home a bit in terms of money and investment.
Yeah, well, you raise a great point, and that's that, like currencies really are the front line of this, right? So obviously you can price in or price out earnings growth. I mean, maybe Canada has a mild recession if the trade war like really happens, because you do export a lot of stuff to the U.S. But what you see on the currency front, I mean, the dollar was up 1% overnight, and I think the loonie was like 147 or something like that, and so that kind of highlights that for a U.S. importer, part of the increased costs from tariffs may well be offset by just a stronger dollar. And this is the market's way of repricing itself to make the world economy still function, right? So the countries that are on the receiving end, and not just Canada and Mexico, but in Europe and India, other places, the currency immediately goes down to offset the effect of any potential tariffs. In China is a little bit different, of course, because they have a managed currency, but there you would see the same thing. They would probably devalue if there was a trade war there. And so that's kind of the market's way of self-correcting or self-protecting itself. But in terms of investor flows, if it's a stronger dollar, you wonder what really happens there if you play this out, because nobody really wants a strong currency for their country, right? Everyone's trying to be competitive, and Trump doesn't necessarily want a strong dollar. So if the dollar were to really take off in a very decisive, lasting way, that would have repercussions, right? Financial conditions would tighten, the US would become maybe less competitive, and then you wonder what the consequences are for that, and whether that is then the thing that forces the US administration to play along a little nicer. So a lot of open questions without answers at this point.
I know, and of course it's all we want to talk about because it's so real and live right now. One question rolling in. This gets a lot of discussion. Are tariffs inflationary? Are they growth shocks? I mean, they're a shock, but how would you talk about
It's a good question, and they can be a little bit of everything. Not to be the two-handed economist, but it really does depend, right? So if and it's very nuanced, right? So obviously, if if the increase, so essentially it's a tax on an import, and if that tax gets passed along to the end consumer, then it's inflationary. If the tax is absorbed by the company because the company doesn't have pricing power, then it eats away at the profit margin, which is then a negative for earnings growth. But again, if a 25%, well, maybe that's an extreme, but if a tax, let's say a 10% tax, is offset by a 5% currency appreciation, then it's only a 5% tax, right? And so there are nuances that offset these things, and then it's a matter of how do the supply chains kick in, right? And the famous example back during the Trump 45 era back in 2016 to 2020 was Whirlpool, what was it, washing machines or something, right? Right. There was a specific tariff on washing machines. Go figure, right? And the price of Whirlpool washing machines like went up 20%, and then it went down. And so because the economy finds other ways to just kind of fill in the gaps, and that would be the hope that the global markets are efficient enough, resilient enough, that there are enough supply chains to allow that to happen. But of course, the tariffs in the first Trump administration were very narrow and very targeted. And what we're seeing so far is much more of a carpet bombing, assuming that this is actually all going to happen, right? And so we don't even really know that. But so to answer the question, it'll be a little bit of everything potentially. And then it's really a question of how do the economies of the affected survive, right? Will you have a mild recession in Canada while the supply chains get reconfigured?
Right, exactly. So another question coming in, should we stay put in these uncertain times? It's sort of the reflex, isn't it, to just maybe not make sudden moves?
Yes, I think definitely stay put. And again, we're supposed to have resilient portfolios in place that can handle all kinds of outcomes, from recession, from inflation, from trade wars, whatever it is. And so, if you feel, or if an investor or an advisor feels that they're over their skis because times are uncertain, then that's a good time to have sort of a gut check and to see whether something needs to be rebalanced. But again, we have no idea what's going to happen next, whether an escalating trade war or whether this is over in 5 minutes or a day. And we saw how quickly that could be the case just after the news out of Mexico this morning. If I was in China, I would probably be more skeptical that this is a negotiating ploy. But in Canada and Mexico and the US, I mean, the USMCA was signed by Trump, and so he's going essentially against his own trade deals, right? So that makes me think that this is really more of bluster than something that's really more systemic, as would be the case with China. I mean, the US doesn't think Canada is an adversary, but it does think China is an adversary. So I think from the Canadian perspective, stay with what's worked, and we end up with the same questions as we always have, which is, what does the markets come down to? It comes down to growth and interest rates and sentiment and diversification, and what roles do bonds play? And you look at gold today. Gold is up. It was up last week, and we've talked about. You weren't here last week, but we talked about kind of this notion of dollar cost averaging into a 60-30-10, where the 10 is gold and Bitcoin. You can even go like a 60-20-20, and we could talk about, actually, we can pull up slide 1 here for a moment, about what else can go into a portfolio that is non-correlated. And really, at times of stress, like we see right now, having a diversified portfolio where stuff is as uncorrelated or as negatively correlated as possible to your main anchor, which of course will be equities, remains important. And so this is a periodic table updated through the first month of 2025. And you can see Bitcoin, gold, equities are still at the top, and actually international equities have done quite well so far. It's only 1 month in, of course, and treasuries and and bonds have not done as well. And if we go to slide 2, you can see just the ranking of the returns. And so it's still kind of the Bitcoin and gold show. And Bitcoin, of course, has this Dr. Jekyll and Mr. Hyde element where it's this aspiring gold-like store of value one day, but it acts like, a 3x QQQ ETF the next day. And that's what it acted like over the weekend. Gold is more of a it's more linear than that and more predictable than that. But those are good anchors to have at a time when the world is not very certain. But then from there, it's, equities and bonds are still going to be your anchors. And the fact that bond yields are very well behaved, 4.5% on the 10-year, I think is a good sign. And bonds have not been negatively correlated to stocks recently since 2022, but they do produce a healthy real yield, right? The bond is 4.5, inflation's around 2.5. So you are getting some income. And so then I think for Canadians, the biggest question is the Canadian dollar, of course. And, do you want to be selling the Canadian dollar at this level? I don't know, probably not, but I'm not a currency expert. But my guess is that many of the clients watching will have a healthy exposure outside of Canada anyway, because that's where most of the market cap is. And yeah, maybe at some point there's an opportunity to bring some of that back if the Canadian dollar gets oversold. But that's a more tactical decision that is a little bit outside of my wheelhouse. But stay diversified, stay invested. The markets will always reprice faster than you can. So to say I'm taking chips off the table because I don't know what's going to happen, that may look good for a while, but when the next step comes, you're going to be behind, and then you're playing catch up.
Yeah. Fantastic. And that look there of 2025 year to date just goes to sort of the story of January, which you talk a bit more about, because there is so much of that as January goes, so goes the rest of the year. It's been a stunning January.
Yes. So January is up about 2.5% for the S&P. The equal weighted S&P is up 3.5%. So that was very nice to see, because in December, as you remember, we kind of like the market breath kind of got sucked out of the market. That happened very abruptly. And so to see the broader market recover, and the MSCI All Country World Index was up over 3%. And, Europe, Japan, all participating in this rally. And actually, if we pull up slide 3 for a moment, you asked about January. So January, we have the January barometer, of course, very popular. And January, when January's up, as the indicator goes, the year as a whole is up 80% of the time by well above average numbers. So if the typical yearly price gain for the S&P is about 8.5%, when January is up, that price gain is in the double digits. It's a little bit of a myth, the indicator. Like, it's true. I mean, those numbers are correct. I've tested them. But it's kind of true for every other month of the year as well. And all it really tells you is that markets tend to trend. And of course, we've been in a cyclical bull market since October of 2022. And the fact that the month is up tells you that the trend is intact. And if the trend is intact, it is more likely to continue than to reverse. And so it's the same kind of indicator that we looked at exactly a year ago, when the S&P finally made a new all-time high after being in that period of limbo since 2022. And those are momentum signs that when there's momentum. Momentum begets more momentum. And so I think that's what the January number says. But if we just look at this chart, which is an eyeful, I apologize, but it just shows the correlation of all the asset classes that I track against every other asset class. The pieces in blue are the assets that are negatively correlated to the S&P. And so the most negatively correlated is the US dollar. And so, which is interesting. I mean, it's not really an asset class, but for Canadians, it's kind of an asset class, right? To stuff denominated US dollars. But what's interesting is that the most recent asset that flipped from red to blue is actually emerging markets. So emerging markets, which have, of course, underperformed in a huge way, are now so disconnected from the S&P that they are actually negatively correlated. And the other one is gold and some commodities and some alternatives. And gold is still interesting that remains uncorrelated, negatively correlated, because gold has really been stealing the show. It was up more than the S&P last year, and it was up 6% in January. And so that's a really interesting one. And of course, I know in Canada, you all love your gold just as much as I do mine. So that's a popular mini anchor, a good diversifier.
Yeah, no, it's fascinating how all the asset classes, as you put up there, and I mean they've all outperformed really. They've all done well. The EM is fascinating because there is probably over conversation of this, the American exceptionalism. At what stage does that shift, and how do you make sure you're ready for it, and so on. So the EM piece is fascinating. It fits a little bit with this overall discussion of DeepSeek, just because there were sort of wobbles in the American exceptionalism for AI to some investors. It was a moment. There's no question.
Yeah, and we see, and January was full of those moments, right? We had fires, we had an FOMC, we had DeepSeek, we had tariffs, we had an inauguration. It felt like a year went by in a few weeks, but it's I'm glad you mentioned EM, because that remains just one of these existential stories or question marks that we are always discussing here amongst my colleagues in asset allocation. And so, how do you divide the pie up globally, right? So from a US perspective, how much do you keep at home versus in developed markets, IFA or EM? And of course, for Canada, it's even more complicated or more binary. Is like, Canada's only a few percent of global market cap. So you kind of have to, it's hard to have all your eggs just sitting at home. And of course, it's been a good strategy to have them outside because of the currency appreciation or depreciation of the Canadian dollar. But so if we go to slide 10, I'll just unpack this. And so one of my jobs is to kind of help set the narrative for my colleagues, as well as you all watching, in terms of, the US, of course, is much more expensive than the rest of the world. You can see this, right? The the S&P forward PE is 22, ex-US is 13.7. That looks like a huge, bubble on one hand for the US and an opportunity on the other hand for the rest of the world. But, that assumes that markets are somehow mispriced, and markets are, if anything, brutally efficient. They're not always right, but they are very efficient in unpacking what's going on. And so my question sort of the week was, how justified is that difference in the valuation? And I come back to something we've talked about many times in the past. If we go to the next slide, valuations can be all over the place. Oftentimes they're justified, not always, but oftentimes they are. And valuation alone is not going to kind of change it's not going to be a catalyst unless you are truly in a bubble and the bubble sort of implodes on itself like it did in 2000 in the US or in 1929. But my work suggests that we're not at those levels at all for like the Nifty 50 or the Max 7. They are expensive, but they're not at bubble-like levels. But if you look here, right, the US is about 60% more expensive than the rest of the world. But if you look at the two lines at the top, the blue and the gray line, one is relative performance, one is relative earnings. they're basically identical. So the reason the US is expensive is because it has better earnings growth. And not only does it have better earnings growth, it returns those earnings to investors more so than in other countries in the form of share buybacks, right? So think of it as a return on equity. If your earnings are growing faster than, let's say, in emerging markets, or they're growing the same, but you're repaying your investors more by returning those earnings in the form of buybacks or dividends, then that's a higher ROE. And so the way I think of this is that if we go to slide 14, and this is my latest chart, is if you look at sort of that ROE over a 5-year period, so what has been the earnings growth and how much of those earnings are redistributed back to shareholders, that's the horizontal. And then you look at the vertical, that's just the PE ratio. You can see that the US is obviously out there, but it seems to be justified, right? Like if anything is not justified, it's India, which is very expensive, but doesn't have the kind of metrics that the US has. And then you look at some of the really bad EM areas, like Eastern Europe, of course, has Russia and those kind of countries in it. So that's going to be an outlier on the one side. But you see Canada in there is kind of where you would expect it to be. And just slicing it one other way to the next slide, 15, is just a slightly different way of showing it, where I'm showing earnings growth on the vertical and that same return on equity on the horizontal. And again, you see it all kind of makes sense. The US is out there, but it's not outside of where the line would indicate it should be. So for global allocation and EMs, EMs have the problem. If you go to slide 16, it's obviously very bifurcated. I mean, China is in one particular spot, India is in another spot, Latin America is in another spot. But you look at the earnings squiggles between the S&P on the top and EM at the bottom, they're moving in opposite direction, and that's more a testament to the Mag 7 pulling the S&P higher. But you go where the earnings growth is, and the relative performance of the S&P versus EM, which is the gray line, is pretty much justified by the diverging direction of those squiggles. And again, EM tends to be dilutive, right? Companies tend to issue more shares. And the US is the opposite. It's buying back shares. And then you get into the chicken and egg story of, okay, is this all an illusion, right? Are these US companies, when they buy back shares, they're basically inflating the earnings per share because they are decreasing the share count, right? And therefore, they are understating the PE by about 20%. And then they distribute those illusionary earnings per share back to investors and get compensated for it with a higher PE. And so that's a philosophical story that I'm sure we could talk about for years, and at some point we'll have an answer to that. But at this point, that dynamic kind of keeps growing. And so my sense is that EM and other areas will work as a trade from time to time, and it'll be fast and furious. But if the big secular engine, like the AI, the Mag 7, that whole return on equity culture in the US, as long as that continues, my guess is that the US exceptionalism continues as well. And I think that means for Canadians as well as US investors, having that US-centric kind of anchor in the portfolio probably still makes sense.
Right. Okay. Fantastic. The Fed paused or just, didn't act. What did you think of that in light of, and also what Jay Powell struggled to not say about tariffs?
So let's slide 7. I think the Fed did exactly the right thing.
Okay.
If you look at this chart, which is a lot of lines, but all those colored lines at the top are different variations of the Taylor rule. The Taylor rule is just an algorithm that says based on where inflation is going and where the unemployment rate is going, this is where the Fed funds rate should be. And you can see when a few years ago, it was very high and it was coming down. So that told us that, okay, the Fed had room to rebalance its policy closer towards neutral. And in my view, neutral is 4%, 3% inflation plus 1% real rates. All those lines came down, which I think gave the Fed the green light to cut 100 basis points. And now all those lines are no longer going down, and they are more or less at the level where the Fed now is. So that tells me that the Fed is basically done here, 4 3/8. Maybe there's another rate cut at some point if inflation really starts to move down again, but it really hasn't moved down at all for like the last year. After coming down to the high twos, it's kind of been stuck there. And the labor market's been strong, so the unemployment rate's no longer going up. And so the Fed is exactly where I think it would want to be. And why cut more when the economy doesn't need it and inflation may or may not have been completely tamed yet? You can always do one later. It's not like the economy's hanging on by a thread, waiting for those rate cuts. I think the action is much more on the long end of the yield curve, and that's more of a market story, less than an economy story. But for Canada, of course, that might change, right? If this is a real trade war and Canada gets into a mild recession, that would lower sort of the floor on where the Bank of Canada might go, and so you might see again more of a divergence there if this really develops.
Well, this is fascinating because that's exactly where I was sort of hoping you would go. The divergence is there, and ultimately, what does it mean? But the further question is sort of, I'm quite curious, even on the fiscal policy story for a lot of different countries, where they sit right now. There's a lot, I think, in Canada, of just sort of wait and then perhaps make tariffs less terrible in any fiscal ways that they need to and possible. But it's interesting on sort of the term premium risk side of things. That still hasn't really been developed, it appears, so far under the new administration in the US. Maybe we just haven't had enough time yet. But do you have clarity on what sort of fiscal spending is or isn't going to happen and what effect that's going to have on the entire rate story?
Yeah, and if we go to slide 9, that's the term premium. But you're right, like in Canada and Mexico, if this is a trade war, it would affect your growth, and you would get tariff relief through fiscal policy and through monetary policy, right? So that would compound the divergence that's already in place with the U.S. Fed. So I think that's one thing that seems relatively clear. For the U.S. term premium, there's still a lot of questions. I mean, you've got Elon Musk clearing out desks over in various departments in Washington right now, taking over the Treasury payments, or at least this is what I'm seeing on social media. Who knows how true it all is? Bessent at Treasury is supposedly a hawk on the debt and deficits. So there is the potential that maybe we do get some sanity on deficit spending, but again, in the US, only a small fraction of spending is really discretionary. Most of it is locked up with entitlements, defense, and now debt service, right? So there's really only so much that can be done. So my sense is that the term premium is still a risk, right? The term premium, which you see at the bottom, generally is positive, as it should be. It's a risk premium. But it's been negative during the QE era. And of course, that era is now over, at least for now.
I mean,
so
can I just ask you about the for now? Because we do hear that swirling. I mean, it seems like an outside chance, but it is talked about, actually.
If rates rise, I mean, that's going to be a problem, right? Because debt service is already $1 trillion a year. Trump actually said he agreed with Powell's decision to hold rates steady. That was a shockingly friendly thing to say. But yeah, I mean, if we get into a debt spiral in the US, there's ways you can fix that, right? The Fed could resume some sort of financial repression like the Bank of Japan has done, or the Fed did back in the 40s. Yield curve control, quantitative easing. It could regulate the banks into doing it for it. It could even make a deal with foreign counterparties, right? Because one of the things that we've had in the U.S. for decades now is this cycle, this rinse repeat cycle of we buy more stuff from you than you buy from us, and therefore we send dollars to you, and then you recycle those dollars back into our treasuries. That keeps our rates low, and that allows us to do all kinds of other stuff. And that is called the Triffin dilemma. And so maybe there's even an incentive that if we're not going to put tariffs on you as long as you keep buying our treasuries and you buy long ones to keep our rates low. Who knows where this could go? And one of the things with this administration is like anything is fair game. Like, with some administrations, you have a sense, okay, that's kind of a third rail. They would never go there. With this administration, anything can happen.
Anything can happen. There's a question about earnings, which I think you were going to talk to. It's linked to tariffs because that's what we're thinking about. So how might this tariff war impact U.S. corporate earnings at all? I mean, this is the question that every country is sort of at least trying to figure out what the scenarios are, aren't they?
Yeah, so slide 5 shows we're in earnings season right now. About 179 companies have reported. 3/4 of them have beaten by 5%. Fairly typical stuff. The bounce in the growth rate has been about 200 basis points so far. Again, it'll be another double-digit quarter. So the earnings story is robust. Earnings inflected in the third quarter of 2023, and the estimates are positive for 2025, 26, and again, for the exporters in the U.S. We export a lot less than we import. I mean, that's the whole reason we're having this tariff conversation. So if there are retaliatory tariffs, say that 5 times fast, it's going to have less of an impact on the U.S. exporters than it will be on Canadian or Mexican exporters. And then it's a question of how U.S. importers deal with that. And again, if currency offsets it, and it's very likely to offset at least part of it, you're not going to see a 25% increase in the dollar offsetting a 25 increase in the cost. So it's not one for one, but that will go a long way to ease the pain. And then it's just a question of how quickly can you make new supply chains, and how long does that take, and how inflationary will that be? Or stagflationary that will be, especially if you're also deporting people at the same time, right? So there's so many dimensions to this story.
Well, I'm so grateful that you could just spend actually a little longer on tariffs, because it really is just so completely, we're absolutely sort of just watching moment to moment. So Jurrien Timmer, a blessing to have you here, and thank you for guiding us through that actually on a pretty consequential day in the Canadian economy's history. Thank you.
Stay strong.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed, their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again, and see you next time.